Gold's move in the last 18 months has not been based on monetary factors. It's been based on central bank buying because of the weaponization of the dollar. So this has been a little bit different. But no, if you look back for the last, as I say, 5 times that the Fed has started cutting rates after raising them, that's when gold takes off. And you know, that's logical when you think about it. So I'm saying gold assets, let's say gold assets. So that includes the gold stocks. It includes silver. The gold assets will take off when the Fed starts to ease. And if they start to ease before they've killed inflation, that's the dramatic move for gold.
Gold has been an alluring option for investors for hundreds of years, and interest in the precious metal has continued to grow over time. For example, last year, gold investing hit an 11-year high as more and more investors flocked to the precious metal to take advantage of its unique benefits. In this video, AdrianDay, the chairman and CEO of AdrianDay Asset Management, shares his perspective on the market trends. In a recent market analysis, AdrianDay expresses surprise at the current market pattern, noting a diminishing impact on gold amid higher inflation and Fed discussions. He suggests a loss of confidence in the Fed's control, indicating a diminishing effectiveness of their market narrative. Despite today's lower inflation rate compared to its peak in 2022, the current 3.1% rate exceeds the Fed's 2% goal, emphasizing the need for a reliable inflation hedge, where gold becomes crucial. However, the relationship between gold and inflation isn't as straightforward. The World Gold Council reports that gold's price changes don't always directly correspond with inflation rate fluctuations. Despite this, gold still performs well overall, having appreciated by 15.5% in the last 12 months. The challenge lies in understanding the intricate dynamics between inflation, Fed actions, and gold's response in the evolving economy. In an intriguing departure from conventional patterns, Adrian mentions an intriguing shift in the gold market in less than 2 years. He points out that gold ETFs have witnessed net outflows for the past 18 months, with consistent weekly and monthly declines. According to him, this trend suggests that the current gold market activity is driven almost exclusively by central bank purchases. In January, central banks reported that they increased global official gold reserves by 39 tons. This was more than double the December net purchases of 17 tons and the 8th consecutive month of net purchases. January's buying also supports our expectation that 2024 will be another solid year of central bank gold demand. Central banks, particularly those in emerging markets, have shown since 2010 that they have a long-term strategy for gold accumulation. While expressing his viewpoint, Adrian believes that gold assets typically surge when the Federal Reserve initiates easing before successfully curbing inflation. Now, we present the clips of AdrianDay's insights from his interview with SOAR Financially. Before we continue, please subscribe to our channel and activate the bell icon for timely updates.
The fact that I'll tell you what I have noticed. So I am surprised by today's move. So I'll lay that on the table. I am surprised by today's move. But what I have noticed over the last, say, 3, 4 months, maybe 5 months, is that when we have a higher inflation number and all the chatters about the Fed not cutting for a while, gold goes down. But week by week, month by month, it seems as though gold is having less of a reaction than the month before to that kind of talk. Am I explaining myself properly? So the effect on the gold price of higher inflation seems to be getting less and less as we go through. So that's one factor. But why gold went up today? And of course, when the number came out, it just shot up. You probably saw that at 8:30. It just shot up, 8 or 8:30, whatever it was. I can't really explain that. The only thing I can think of is that the market is saying, the Fed's losing control. The Fed's narrative is not working. If you go back and look at the last, 5 or 6 times that the Fed has started cutting after increasing, that is precisely when gold takes off. This time's a little bit different, of course. We can talk about that. I mean, everybody knows it's because of central bank buying. So it's not a monetary, gold's move in the last 18 months has not been based on monetary factors. It's been based on central bank buying because of the weaponization of the dollar. So this has been a little bit different. But no, if you look back for the last, as I say, 5 times that the Fed has started cutting rates after raising them, that's when gold takes off. And you know, that's logical when you think about it. So I'm saying gold assets, let's say gold assets. So that includes the gold stocks. It includes silver. The gold assets will take off when the Fed starts to ease. And if they start to ease before they've killed inflation, that's the dramatic move for gold. That'll be the dramatic move for gold. I think it is almost entirely central bank buying. If you look at other sort of, if you look at other areas, you look at the gold ETFs. The gold ETFs have seen net outflows for the last 18 months. Not every single week, not every single month, but the majority of weeks and the majority of months. You look at ETFs this year, you've had net outflows from gold ETFs every single week this year. In fact, we've now had, as of February 15th, which is the last numbers I saw for all of the global ETFs, we've had 44 tons move out of global gold ETFs, which is more than all of last year. So whoever are buyers of ETFs are not bullish on gold. They are not buying gold for monetary reasons, for geopolitical reasons, or for any other reason. If you look at coin sales, which is a good indicator of retail, they're down. The premiums are way down as well. So there's not a vibrant there's not a vibrant coin market at the moment. So the retail people are not rushing out to buy gold because of Israel and Gaza and so on. So I think it's almost exclusively central bank buying, to be honest with you. There's also been some buying from very, very wealthy families in the Mideast, and some, to a lesser extent, from wealthy families in Hong Kong, China. But those people tend to have the same kind of motivations as central banks, right? They want a hedge. They're buying for defensive reasons, for insurance. And so in those circumstances, you buy physical gold. You don't buy mining stocks, and you don't buy silver, right? You buy physical gold, and you are also price agnostic.
AdrianDay states the current negative sentiment among gold investors, leading to a cautious wait-and-see approach. With the broader market achieving notable performances in 401ks and S&P index funds, he notes a reduced sense of urgency among individuals to invest in gold or silver. The S&P 500 fell 28% versus gold from late 2021 through 2022, and despite its 2023 rebound led by mega-cap companies dubbed the Magnificent Seven, it remains 5% lower versus gold as of late February 2024, despite being about 6% above its 2021 highs, when expressed in dollar terms. Furthermore, Adrian observes that the impact of geopolitical events on gold prices tends to be short-lived. Instances like the Russian invasion of Ukraine and 9/11 showed a swift but temporary rise in gold, returning to pre-event levels within 3 months.
I mean, I think it's sentiment is a huge factor in any kind of market, and sentiment tends to sort of go in these waves. And so when sentiment is as negative as it is right now, nobody feels they need to buy something, and they certainly don't feel they need to buy it now. There's very much among gold investors, I think there's very much a wait and see attitude. We'll get lower prices, we'll get better prices later if we wait. I don't know. The other factor, of course, is that the broad market is doing so well. If people have money in 401ks, or they've just bought S&P index funds or whatever, they're doing very, very well. And so the need to buy gold doesn't seem as apparent as it would if gold was not doing well. I think if we see the inflation numbers pick up, as I say, 0.4% month on month is sort of an irrelevancy. But if we see that for the next 3 or 4 months, then I think you'll start to see at least individuals start buying coins for protection, because retail tends to respond to inflation. They will buy gold when inflation's moving up. Whereas, the most important factors on gold are not necessarily inflation moving up, but it's more easy monetary policy that moves gold. If we're just looking at what would the impact on gold be, I mean, the impact on gold would be positive. But again, geopolitical events like that tend to not be long lasting. We saw this with the Russian invasion, of course. Gold had already moved up. And this is often what happens. Gold moves up ahead of an event because of, rumors in the market, anticipation, and so on. And then it spiked when Russian troops moved into Ukraine. And then within 3 months, it was back to where it was, before the whole thing had started. And, that's been true of every geopolitical event, frankly, since 1980 with the Iran hostage. The Iran hostage had a big impact on gold, but that was when gold was already in a very sharp up move. But even if you look at something, an event like 9/11, the effect on gold which came out of the blue, and you could argue was was a very dramatic event, came out of the blue. So the gold price hadn't already anticipated it. And yet within 3 months, we were back to where we were before. So geopolitical events tend not to have a long lasting.
Gold prices are elevated right now, but that doesn't mean you should wait to buy in. If you've been considering a gold investment, adding gold to your portfolio now makes sense, given its unique benefits relevant in today's economic environment. What are your predictions for the future of gold, and how do you anticipate these intricate factors influencing its trajectory? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.